They called it the most anticipated crash in history, but no one was ready for what came next. Every indicator flashed red, yields inverted, credit spreads widened, and tech valuations hit levels unseen since 2000. And yet, the crowd said, this time is different. The year is 2026, and the world is entering a bear market that's been years in the making. Not because of a single event, but because of a slow, invisible decay across every layer of the global economy. The warning signs began long before the first sell-off. By late 2025, inflation had cooled, but growth cooled even faster. Central banks that spent years fighting rising prices suddenly found themselves trapped. Cut rates too early and risk a second inflation wave. Hold too long and break the system. It was a no-win game. The cracks appeared first in the bond market, the same place every major crisis begins. The U.S. yield curve, inverted for nearly 3 years, had become a ticking time bomb. Corporate debt, much of it issued during the zero-rate era, began to roll over. Trillions refinanced at double or triple the cost. Balance sheets buckled. Defaults surged. And for the first time since 2008, even investment-grade debt wasn't safe. Then came equities. At first, it looked like just another correction, a 10% dip, quickly bought up by dip-hungry algorithms. But beneath the surface, liquidity was evaporating. Buybacks slowed, earnings guidance was slashed, and margin debt hit record highs. The Fed's pivot wasn't a rescue. It was confirmation the slowdown had begun. And that's when the bear market became official. This wasn't the sudden collapse of 2020 or the panic of 2008. It was slower, colder, more calculated. A rolling downturn that started with small cap stocks, spread to real estate, then finally consumed the giants of the Nasdaq, Tesla, Apple, Nvidia, the holy trinity of the 2020s bull run, all down 60% from their peaks. Investors who once mocked bears on social media quietly vanished. The AI bubble narrative collapsed under the weight of rising bond yields and slowing adoption curves. And suddenly, everyone remembered valuations still matter. But the stock market wasn't the only casualty. The real damage was global. Europe slipped into stagflation, caught between energy insecurity and fiscal exhaustion. China's property market imploded further, forcing the PBOC into its most aggressive liquidity injection since 2015. Emerging markets saw their currencies crumble as capital fled to the dollar again. And commodities. Gold soared. Oil collapsed. Copper, the heartbeat of global manufacturing, sank to multi-year lows. For those who understood macro, it was all predictable. The seeds of the 2026 bear market were sown years earlier. Zero-rate addiction, fiscal overreach, geopolitical fragmentation, and an entire generation of traders who had never seen a real downturn. The result was a systemic repricing of everything, not just risk assets, but risk itself. Let's break it down. The first domino was liquidity. From 2020 to 2024, global central banks printed over $25 trillion. That liquidity inflated every market: equities, crypto, real estate, even fine art. But by 2025, quantitative tightening had drained more than half of it. Money supply growth went negative, a rare ominous signal that has preceded every major bear market in modern history. The second domino was earnings. Corporate profits peaked in Q1 2025, then rolled over. Revenue growth slowed, costs remained high, and margin compression became relentless. Tech firms that had relied on perpetual growth hit the wall. Layoffs returned. Consumer confidence plunged. And then the third domino, policy exhaustion. Governments had already spent their ammunition: fiscal stimulus, pandemic relief, green subsidies, and defense budgets. Debt to GDP ratios hit levels that made new spending politically toxic. So when the slowdown came, there was no cavalry left. The bear market wasn't triggered by fear. It was triggered by fatigue. But the psychology was textbook. Hope, denial, anger, capitulation. Every bounce was labeled the bottom. Every rally was the recovery, until it wasn't. By mid-2026, the S&P 500 was down 35%. The Nasdaq had lost nearly half its value, and the average investor had given up. Yet within that despair came the greatest transfer of wealth in over a decade. Because while most sold in panic, A small minority quietly prepared for the next cycle. They understood that every bear market carries the DNA of the next bull. They looked at liquidity conditions, forward earnings, real rates, and saw that when fear peaked, opportunity was near. They remembered 2009. They remembered 2020. And they knew that this, too, would end. The 2026 bear market wasn't the end of capitalism. It was the end of denial. The end of believing that free money could last forever. The end of thinking markets only go up. It was a reset, painful, cleansing, and necessary. Because the truth is, markets don't reward comfort. They reward conviction. They reward patience. And they reward those who can stay rational when everyone else loses their minds. So what happens next? History tells us that every major bear market lasts about 18 to 24 months. That means by late 2027, the recovery will begin, slow, uneven, and fragile at first. But it will come. AI will evolve beyond hype into productivity. Energy will stabilize. Central banks will pivot again, not because they want to, but because they have to. And new leaders will emerge, the industries that survive the purge. Clean tech, cybersecurity, defense, and once again gold. The lesson of 2026 isn't to fear the bear, it's to understand it. To recognize that downturns aren't disasters, they're cycles. And that wealth isn't built by timing the top or bottom. It's built by surviving the middle. So when you hear the words bear market, don't picture chaos. Picture clarity. Because in every market collapse, there's one constant truth. Smart money doesn't run, it repositions. And when the dust settles, those who stay disciplined won't just recover. They'll dominate the next decade. If you've learned something from this video, if it's made you think differently about markets, cycles, or even fear, then don't just move on. Like this video, share it with someone who needs perspective. And subscribe for more insights on the real forces shaping the world economy. Because understanding the bear isn't the end of your journey. It's the beginning of mastering it.